Hello and welcome to this week's market update. Thank you so much for joining me. My name is Sean Allison, the founder of Cashflow Options. Now, let's talk about the market. Fear is coming into this market, and for a good reason, or good reasons. I'll talk about those in a moment, but we're seeing right now that there is fear coming into the market. The put-call ratio is showing us fear is creeping into the market. Market momentum, we'll talk about that as well. The stock price strength is extreme fear, along with the overall stock price breadth is extreme fear as well. Safe haven demand is showing extreme fear. Now, some of the things that we track is the skew. Now, the skew is the perceived risk of a 2 standard deviation move or more to the downside. In English, a market crash. When this figure here, or maybe here, is above 135, that's bearish. That shows that the smart money is worried about a market crash. So 150 is very high, right? It was as high as 160 recently, but yeah, very high. Smart money is certainly worried about a market crash. When they're worried, we should be as well. The total put-call ratio. Now, right now, the 10-day moving average of that is 0.77. Anything 0.75 or close to it or lower is showing that the market could sell off. Okay, this is a bearish sign. The combined, well, that was a combined put-call ratio. The SPX put-call ratio, something 1.75 or below shows excessive call buying and looking for a top. It's bearish. Right now, 1.95, we're neutral on that particular reading. One of the things that I like to look at is the number of stocks or percentage of stocks that are above their 50-day moving average. And right now, that's at 44.36. Anything below 50% is a bit of a concern with the market. So, there are some bearish signs here that I am concerned about, no doubt about that. Margin debt is at record levels. It was up again. People borrowing money to buy shares. That has gone to another high in May. Just extreme greed going on right now. But what we need to do is look at our opening range. Now, our opening range is going to tell us, whether the market is bullish, bearish, or it is in neutral zone. Now, when we set it up for the third Friday, in fact, I'll do that now, right? Because what I've done is I've reset it here and I'll reset those lines. So let me clear that. I want you to look at this because this is very important here, what I'm about to say about the overall market, SPX. The SPX is the best gauge of the overall stock market, so we need to be able to look at that. Now, when we looked at it from last opening range, which is this price here, this day here, okay? So we do this twice a month, on the first trading day of the month and the third Friday of the month, monthly options expiry. So we set the high and the low. Now, as of Friday, it broke into bearish opening range mode. So we are in bearish opening range mode, meaning that the market is likely to continue to move down. However, what was Friday just gone? It was the third Friday. So that would mean we have to reset that opening range now. So we can reset it right now. Set the high and the low of that day. This is over 90% accurate. So these are the numbers you need to watch. 4164.40. If it closes below that on the SPX on a daily chart, close below there, that is the overall market is in bearish mode, right? Watch out for things to continue to move down. In between the two is neutral, and above 4204.78 is bullish. So be mindful of that as well. They're the two numbers that you need to watch in the days ahead. Now, the other thing that has got me concerned about this market and believing that the market could move down, if we take this back all the way back to, and if I just take those lines off for a second. Okay, so if we take this all the way back to March 2020, when the world was first hit with this pandemic, let's have a look. Right there. Okay, so this trend line going all the way back to March 2020 has been intact, and the market has respected it over and over, even recently, double bottom respected that. Just Friday, it was the first time that it's closed below this. Are there algorithms that are set to watch this and maybe set off selling as a result? Yes. Is there institutions looking at this same trend line? You better believe there are. So this is a very bearish development as well, and something that is a bit of a concern also. Okay, so the fact that we've closed below that now is another reason, not just in and of itself, but is another reason why this market could continue to move down. So I'm certainly concerned about that as well. Now, if we look at the overall market, I'm not concerned because I can make money whether it's up or down, right? So what we're doing with my members is we're closing out all of our positions right now because we've got quite a few bullish ones that we've done very well with, which I'll speak about in a moment. One I spoke about with you last week. And we're resetting some very high risk to reward opportunities for when the market, if the market was to fall. If it continued to go up, we'd have very small losses. So it's a very good way of doing it. For example, one of the positions we're setting up on the SPY has a $90 maximum risk per contract, and the potential upside is $811. So we've got a 9-to-1 risk to reward. If the market does want to continue to go up, because again, the market can do whatever it wants to do. If it wants to continue to go up and be bullish and break to new highs and a brand new opening range to the upside, great. We're only going to lose $90 per contract on that trade. But if it does move down, like I believe it will over the next month or so, we could have a move down to 3,800 on the SPX or 380 on the SPY. If that does happen, we'll make 9 times our 9 times return on the amount of risk that we're taking. In other words, using asymmetrical risk in our favor dramatically, skewing it in our favor and structuring the trade in that way, which is obviously very, very important. So that's what we're doing right now. So you can see right now, all the major indexes are below their 21-day moving average, exponential moving average on the daily chart, except for the NASDAQ, which I did call. I called this several weeks. I said this is going to break to new highs here, and that's exactly what it's done. But right now, we need to look at the overall market, and let's have a bit more of a look at it. So we got to new highs, and now we've just closed below the 50-day moving average here on the daily chart, right? If I look at the Russell 2000, that's closed below the 50-day moving average with some very good volume there as well. If we have a look here, obviously the NASDAQ, that's above, okay, but that's had a pretty big move, and you could start to see some downward movement in this as well. So that's certainly the strongest of the lot, and we will see. It hasn't shown us any bearishness yet. We look at the transports, definitely broken below the 50, moving down. Okay, so it's definitely some weakness in the transports. And if we have a look here at the industrials, they've broken below their 50-day moving average as well. So, you're getting all the major indexes below their 21 and 50-day moving average, except for the NASDAQ, right? Technology-based companies are still holding up relatively well. For me, the SPY, SPX, same thing. I think we could have a move down to this 200-day moving average, 380. I think that could be on the cards. When, Sean? Well, obviously don't know exactly when, but, within the next month or so. Okay, could very easily come down here. But again, if it does move up, I'm going to have a very small risk, and this is the power of options. This is why they destroy any other investment vehicle out there. We've got a very small risk, $90 a contract. But if it does move down, we are going to make 9 times our money, 9 times as much reward as the risk that we're taking, which is pretty impressive. So we've got that set up now. I think that's really important. Last week I spoke to you about APPN. What a great trade that was. Look at that, breaking out of the bull flag, breaking above the 200, looks really good. But with the overall market looking bearish to me right now, I'm going to take a 41% return in 4 days, right? 41% return, made over $1,080 a contract profit. 41% return. So that was a great trade. I spoke about that last week. Let me know if you got into that in any way, and send an email to support@cashflowoptions, all one word, cashflowoptions with an s.com.au. PayPal was another one that we were in. We did very nicely with this one as well. We set this one up, bull flag above the 21 and the 50. We had our stop at 260. Our target was 295. We've had a nice move. What I'm going to do with this one is I'm just going to close this one now, right? So we bought a lot of times we do spreads and we do a whole range of things to minimize the risk. But for me with this one, we actually bought the option, the 260 strike call. We bought it for $28.93. It's now worth $42.48. Right? Happy days. 47% return in 11 days. So those two trades, we have absolutely crushed it, along with other trades that we had on. But we're closing them out now just because of the overall my bearish take on the market. So Sean, what are some of the things that you're seeing? I understand you've got a 9-to-1 risk to reward in your favor with the SPY setup, but also anything else that you're looking at? Yes, I'm looking at BSX. BSX, if I look at it probably on this chart, okay, I'm looking for this to move down. BXS, not SX. XS, that's the one. So this one here, we have a head and shoulders pattern here. It's broken the neckline at 29. If we go from the top of the head, which is 35, around 35, okay, and then we go to the neckline 29, that's $6. I would expect that same $6 move to the downside. So my target here is 23. Breaking the 29 here. There's a couple of different ways that we've set this up. Again, you can utilize the power of options to have a very small risk on this, okay? An $80 risk per contract with a $340 potential upside. So this is the beautiful thing about options. And so we've got that one set up, or that's one we're going to set up. That one looks okay. Looking for that one to the downside, and some big volume as well. Look at the volume, almost 4 million. The 50-day moving average volume here is around 1 million. So almost 4 times as much volume, breaking this neckline, and also breaking the 200 from memory. Yeah, well, closing below the 200 as well with big volume. Could be igniting volume, could have a move down. 23 is the target. If it does, all of a sudden reverse and move to the upside, 29 is your stop, right? If it gets above 29, close above 29 on the daily chart, just exit the trade, okay? So that is one that we are looking at, right, to the downside. And another one here is this one. Now this one here, a bit of a bear flag here, okay? A bit of a bear flag forming here. The other thing is with this one, it's broken this trend line here. See this trend line going through here? Just closed below that. So that's very interesting for me. Very interesting. Based on the bear flag, could have a move down to 58. So again, put options, looking to make money on the way down, right? We're going to set up a spread and maybe an option there to actually really take advantage of this break of this trend line and out of this bearish charting pattern, okay? So that's another one that we are looking at. Now, the only other one that I looked at to the upside, about 85% of stocks will move with the market, which is why we always look at the market, right? Because most stocks move the same way as the market. So 85% do move with the market, which means what? 15% don't. So we are looking at one high short interest trade. High short interest trade here. This one is on OTRK. Now this one has 33% short interest and 14 days to cover, which simply means it's going to take 14 days of average trading volume to buy back all the short stock. That could see a pretty significant short squeeze. It's got a gap to fill here at around $56 as well. So this one's interesting. One of the things that we use as well, one of the setups, one of the edges we use in our trading is something called a squeeze, where the Bollinger Bands are inside the Keltner channel. So you can see the Bollinger Bands here are well inside the Keltner channels, looking to break out, need the upper one to break out here, but this is a pretty big daily squeeze here as well. So we've got a big daily squeeze, okay, that could see this stock break out and move to the upside. We've got high short interest, over 33%, 14 days to cover or short ratio, and we've got a gap to fill. So, yeah, not bad. Two ways of trading it. Buy the option or actually set up spreads. We just needed to get above 40, and we're going to make a very big return on this. So, that's another one to the upside. But again, my overall view on the market is bearish. And they're the things that I am looking at right now, my friends. But we will see. On Tuesday, we will know the opening range. And, a couple of other things here. I'll just show you this. XLK, so there's some stocks that we're looking at anyway, just to add some value. XLK is the largest sector in the market. The biggest component of that sector is Apple, making up around 21% of that sector. And if you have a look at this, probably if I look at this chart here, this setup, yeah. Apple within a trading range hasn't really been doing a whole lot as far as price action goes, hovering around the 200, not really doing much at all. So it's certainly not in a huge, strong uptrend like it was back here, just in a trading range going sideways. That accounts for 21% of the largest sector in the market. Microsoft accounts for 20% of XLK, which is the largest sector. That recently has just been going sideways as well, not doing a whole lot. XLV, which is healthcare, okay, the second biggest sector there, certainly that's been grinding higher. But what's the largest component of that sector? Well, it is Johnson & Johnson. Johnson & Johnson makes up around 10% of the healthcare sector, and you can see that that's well below its 50-day moving average, with some pretty good volume there as well. Not really showing us a lot of strength. The second biggest stock making up that sector, healthcare, is United Health, making up around 8%. That's well below its 50-day moving average. If we move down to the next biggest sector, which is consumer discretionary, we can see here that's already below. If I just bring this in a little bit, it's going to be a bit more helpful. It's already below its 50-day moving average. Okay, the largest component of consumer discretionary is Amazon. Right now, Amazon again hasn't been doing a whole lot. It's just been going sideways. In fact, Jeff Bezos has sold quite a few $1 billion worth of this stock recently, just in a sideways trading range, right? So not really doing a lot. Accounts for 25% of consumer discretionary. Tesla accounts for 12% of consumer discretionary, and that's just barely holding on to the 200-day moving average, moving down from highs of 900 down to 623. Not a whole lot of strength there either. Home Depot makes up around 9% of consumer discretionary. That's well below its 50-day moving average. Now, XLC, which is communications, that's the next biggest sector. Yeah, that's been grinding higher. This one probably looks the best of the lot. Facebook accounts for 23% of that sector, the communications sector, XLC. That looks okay, right? And then Google, Class A and also C. These are a couple of stocks here that account for a large portion of XLC as well, combined about 25%. So, and that's been looking quite good, right? Nothing wrong with Google. And then if we go down finally to XLF, I have got a point here. Stick with me, right? XLF. The next biggest sector here, that's just really fallen off a cliff recently. Big volume too, breaking below the 21 and the 50-day moving average. The largest component there is Berkshire Hathaway B-class shares. If we have a look at them, that's well below its 50-day moving average. Financials, the second biggest component of financials is JP Morgan, accounts for 11%. Berkshire Hathaway 13%. That's well below its 50-day moving average. And then the Bank of America, which accounts for around 7-8%. That's well below its 50-day moving average. So there's 12 of the biggest stocks that represent the 5 biggest sectors in the market. 7 of them are below the 50-day moving average and the 21-day moving average. 2 of them are in trading ranges. So 9 of the 12 are either bearish or doing nothing, and only 3 of them are actually showing any sort of strength. So we're not getting a lot of strength in the biggest sectors in the market with the biggest stocks that make up those sectors as well. And recently we've had lumber and gold, and lumber's really come off. It's actually broken out now from its upward channel. Just incredible move high. It's now broken that, so we're certainly now confirming a downtrend there. Gold has had a big move down, right? Interest rates looking like they're probably going to be risen to battle inflation. That's what the Fed's sort of hinting at now. Gold didn't like that very much, but I think it's probably going to bounce off this trend line and then move higher from here. So if we get gold moving higher, lumber moving down, that's another very bearish sign for the market. So again, that's just my overall view on the market. I hope you found that somewhat useful. And you think about something like Apple. You look at something like Apple. This is held by 146 different hedge funds. Okay, and it's about $142 billion worth of hedge fund money is invested in this particular stock. So, some of the biggest stocks with the biggest institutional money are not performing. They're going sideways, or they've all broken their 50-day moving averages and moving down dramatically. Then this is something that you've got to be aware of. More than 50% of stocks are below their 50-day moving average. Citigroup, that has 95 different hedge funds and $7 billion that is invested in it. So, you're getting these huge stocks now that are not really performing. This market's starting to show some signs, and to set something up right now that would have a minimal risk if you're wrong and a very big potential profit if you're right, in other words, the market moves down, to me, just makes a lot of sense, right? That's the way you make money with trading. It's not about your win rate. People will say that to me sometimes. Sean, what's your win rate? It's not about your win rate. If anyone says that to me, I know they know nothing about trading. Zilch. It's about how much you make on your winning trades compared to how much you lose on your losing trades. Structuring your trades, utilizing asymmetrical risk. That's the way you make money with trading. It's not about being right all the time, right? That doesn't exist. It's called fairyland. We want to be able to do this for a living, and we do this for a living because we understand we can structure our trades. We can have a very small risk, particularly with options, and the potential upside can be much greater. So, that's the way that we trade, and it works very well for us. We've done very, very well recently. We've flattened all of our positions now, except for those couple there that I just showed you that we're looking to get into. So let's see what the market gives us. Let's see what the opening range will be on Tuesday. We'll know the new opening range. And let me know if you enjoyed that, and if you got into APPN or LMND was another one I spoke about. PayPal I told you guys about. I've given you some really cracking trades recently. Obviously, you're not members, so I don't show you exactly all the detail of the trade, but there's been some pretty good trades there recently as well. So let me know your feedback. support@cashflowoptions.com.au. If you want to subscribe, go ahead and do that. Click the like button as well, and let me know what you think. All right, my friends, my name's Sean Allison. I'll talk to you again next week. All the best, and bye for now.